In this segment, we'll be addressing fears of the unknown, working capital, and tax implications in the sales process of a business.
Welcome to Business Innovators Radio, featuring industry influencers and trendsetters sharing proven strategies to help you build a better life right now.
Welcome to the program. I'm Mark Imperial. This special series is all about selling your business in Canada. Joining me on this segment is special guest expert, business broker Jim Nairn. Jim, welcome to the program.
Hi, Mark. Thank you for having me.
Please tell me a little bit about working capital and tax implications in the context of selling a business in Canada.
Well, the working capital is a huge topic in the industry, and we do workshops on it all the time at all the conferences. There's always at least one class on it, if not multiple classes. Throughout the year, they always give a few different workshops as well. It's a highly kind of debated and disputed topic, and even between the various professionals, between accountants and lawyers, there's always some kinds of discrepancies that can happen between one side's interpretation of what should be included in the working capital and the other side's interpretation. They can be pretty desperate, depending again on the nature of the business. But the working capital is definitely a huge topic, and the sellers unfortunately never want to leave any more than they absolutely have to in a deal, whereas the buyers are quite often okay to gain access to a little bit more just to help them sustain them a little bit longer after the deal is done. But there's certainly can be a lot of debate over it.
Since it can become complex, what's the biggest question for business owners, or what question do they have, when it comes to managing working capital and navigating tax implications when preparing a business for sale?
So quite often with the working capital aspect of the transactions, what the business owners are always wanting again is to leave as little as possible that they actually need to in the business for a deal to happen. However, what they often fail to realize is that there is pretty much always needing to be some amount of working capital, whether it's even just a basic amount of $2,000 or $3,000 worth of inventory. That is actually part of working capital. But when you start getting into the more complex businesses, what the business needs to operate is the amount of working capital that is going to be needed in the sale of the business. So if you're running a $20 million a year, say, construction company, you're going to have all kinds of various components of inventory depending on the natures of the jobs that you're working on. Some of the jobs are going to be near completion, some of the jobs are getting ready to be started, and some of them are fully underway, and you've got to have your inventory levels set up to be ready for that, as you know, when you're preparing your business just on an ongoing basis. And so when a new owner comes in to take over, they're going to need that same level of inventory that's going to be going to comprise of cash to cover the people's payroll and the bills while the sales are still transpiring, because sometimes some businesses don't get paid for 60 to 90, 180 days after a job's been completed. And in order for a buyer to be able to get money to pay their bills going forward, chances are they're going to need to have some left in the accounts to help sustain them until such time as they can get a strong and steady revenue stream. And then again, you have your basic inventory. Sometimes it will be inclusive of accounts receivables as well, just in case there's not a whole lot of cash available on hand. And sometimes there's also debt obligations that go along with with the networking capital, because you have things like gift cards or customer deposits that have been received or given out over the term of the nature of the business. So you have to account for all of that to be going forward as well. So there's just so many different levels and layers of complexity that can happen in the working capital discussion that yeah, you really need someone that has a working understanding of what's actually needed in the business. And we try to get that understanding in preparation before getting the business ready for market to say, hey, you know what? You're going to need to leave in your sale price is X, but you're going to need to leave in this amount of working capital in order to be able to receive that money when you go to market. And sometimes they're not always happy about that message, but that's what's needed in order for the business to continue its current operations. And that's what a buyer is going to want to buy. They're not going to want to buy a business and then have to turn around and put in another anywhere from $100,000 to $500,000 worth of an investment in inventory and materials and paying bills until they start receiving money coming in. They want that. They want the business to be all ready to go when they take over, generally speaking.
So this sounds like an area that really has to be dialed in. So in that case, are there any misconceptions around the dials, so to speak, that are going to affect, business owners' perspectives on selling?
So there's lots of things that we find business owners do sometimes with the different aspects of their business. Sometimes inventory can be a big one. We know for tax purposes that every now and again, some companies will do what's known as writing off of inventory, so that they don't have to pay as much taxes on at the end of the year. But yet they've got a warehouse full of this fully serviceable, ready to be sold inventory, but it's just not on the books anymore because of tax purposes kind of thing. But then when it comes time to sell the business, they have their normal inventory that's on the books, and they have all this what's known as what we call excess inventory that's over here that now, well, what do we do with that when we go to get ready to sell, right? So we have to do some juggling sometime to say, hey, you know what? The buyers are like, well, what do I need all that excess inventory for? If you didn't sell it and you made it, why do I need it? Why shouldn't I just take what's already there and you deal with whatever's left over on your own end? Because you know, why should I go through the hassle? So yeah, there's a few different things out there. So it's kind of one of those, again, to helping prepare to get ready for going to market. Just sometimes it takes a couple of years maybe of adjusting some of those practices to get the business a little more finely tuned, so you don't have that big of an issue, or preferably no issues when it comes to dealing with things like that. And there's also times where the business has a lot of accounts receivables where they just are sometimes really slow on collecting their invoices in. So that can really impact the cash flow and whatnot that a new business owner would have to work with. So sometimes we give them a couple of years to get that part of the business a little bit more in tune to say, hey, you know what, instead of being the bank for your customers and potentially your suppliers, let's turn around and let's just get paid, and then you can you can operate your business a little more comfortably.
What kind of mistakes can people make that you could help them avoid when it comes time to sort of navigating these tax implications?
So again, the big one is the preparation. So understanding that, yes, you know what, while you can save taxes sometimes early on in the short term by doing things like writing off the inventory or not claiming certain things as accurately as you could, if you actually put the pay your taxes properly in accordance with regular operations of a business, you can actually receive a better value on your business, even more so than what the taxes expense was. So, say you paid 15,000 in taxes, you could actually reap more than that with the value of your business when you sell. So I can't give you an exact kind of number of what that relationship is, because each one is situationally dependent. But yeah, chances are you're going to get more than what you're going to get back more than what you paid in taxes if you run your business tax properly, shall we say? Is that the right term? Something like that.
Is this part of the process that you directly help people with? And tell me give us a 10,000 foot view of what that looks like when you go in there and help them with that strategy. What does that look like?
Yeah, so it's really very similar to what I was saying. It's getting an understanding of just how much of that sort of thing that they're doing. I prefer to have as close to a 3 to 5 year window of, say, what we refer to as being like clean books, where we really don't have to do much recasting at all. And the recasting is adjusting for the different things that I was kind of alluding to. So if the business can run cleanly and pay the taxes appropriately for that 3 to 5 year window, and there's little to no adjustments to be made, the buyers and the banks have a lot more faith in the operations and the numbers that they're seeing from the business doing that, and they have a lot more confidence to be able to pay a little bit more of a premium potentially on a business that's operating that way. So again, you can actually make a lot more money sometimes, given the nature of a successful business that's operating in a growing environment and a growing industry. That your return could be well worth the investment of just simply cleaning your books and making it run properly.
Is there anything that I didn't think to ask you in regards to working capital or tax implications that you really feel you need to share?
So sometimes, the working capital again is a huge issue, and it's debated all over our industry, and just sometimes even getting an understanding of it. And as you go up in complexity in the nature of the business, the complexity and the level of the working capital increases proportionately, shall we say. So it's one of those where it can be a highly debated uh, part of the agreement to say, yes, this needs to be included in the working capital, or no, it's not, or this is the value that you're going to get. You have to deal with it. And there's all these different aspects to it. So it's one of those where, again, having people that understands what's involved in it and can be able to identify the what should be needed up front. And I usually do that. Part of the way that I do that is by getting a monthly balance sheets for at least the last 2 years of operations, so I can see the ebbs and flows of the cash flows, the inventories, the accounts payables, the accounts receivables, to say, hey, here's the peaks and valleys, the seasonality of the business. Let's try and smooth that out. And if the business is going to be sold, say in the spring when that's their peak time, well, guess what? You're going to have a lot of excess XYZ on the books, and we're going to have to be able to account for that when it comes time. Or if it's going to be sold in the slower times, well, then you know what, the value is here, but it was based on your levels being here, so now we have to adjust for going the other way. So it's you need to have that understanding for when you're dealing with those kind of current asset and current liability intense businesses, to say, hey, this is the ebbs and flows, and this is what we need to be ready for if and when things happen here or there.
Jim, this has been terrific. Thanks for joining me on the program today, and I wish you continued success for you and your clients.
Thank you very much, Mark. I appreciate that, and I hope you and everyone else has an amazing rest of the day. So if you enjoyed this video and want more real world information about buying, selling, and or valuing a business, feel free to connect with me directly on LinkedIn or through my website at trilliumbusinessbrokerage.com. Either way, I'd love to connect and keep the conversation going.